name is Sthembiso from Durban University of Technology in South Africa. I'm here to present my paper, which is titled Microeconomic and Firm-Specific Determinants of Financial Performance of the Evidence from Non-Life Insurance Companies. Just to give a background, the insurance companies are crucial for financial institutions that stimulate the economic growth. As you all know that in the African continent, in particular, the majority of the developing countries, the financial companies or financial institutions are at the center or the heart of the economic growth of those countries. The insurance companies protect individuals and contribute to economic growth by bringing more monies whenever are needed. The non-life insurance companies is pivotal or vital for economic growth for the developing and the developed countries. According to this researcher, the ever-changing climate change, which continue to ravage people's life and ravage many businesses, has led to more global risk, which subsequently have created more demand for the non-life insurance coverage. The insurance companies are continuing to struggle with that, which lead them to rush into non-life insurance companies for more money for them to actually protect their businesses, which subsequently creates a more demand and need for non-life insurance companies to be more performing whenever they are needed to. Financial profitability or profitability has been a challenge for many African non-life insurance companies. This is due to fall of rates, increase of claim, growth of expenses, which has been brought about by many changes that have happened, which I can cite COVID-19, I can cite globalization, market liberalization, intense competition amongst companies, and which all of those things has been the real reason as to why insurance companies has not been performing. And also, despite that, the non-life insurance companies has experienced a significant growth in terms of the gross written profit. This means that despite the current de-evaluation, but there's still a potential for these insurance companies. There's still a potential for non-life insurance companies to actually grow. Hence, understanding the key elements which influence the financial performance of non-life insurance companies is crucial for the economic advancement for the continent and countries like African countries. Financial performance is a significant factor which influences the public perception on to say, can we do business with this particular insurance or not? Hence, it's important that these companies, they actually perform to their best ability. There's been so many researchers and scholars around the world who have actually looked into factors that affect the performance of non-life insurance companies and insurance in general. We can name researchers or scholars from Kenya, Romania, as well as Zimbabwe, in India, as well as Ethiopia and United Kingdom. However, also there's been also a scholar in Pakistan. However, all of these researchers, they've actually looked into macro and firm-specific factors on how they influence insurance companies. However, none of these researchers has looked, one, into non-life insurance companies, which have created a gap. Two, none of them have looked into the African continent, which would give a more view as to why African insurance companies are least performing or are least penetrating around the globe. Hence, this study will focus on non-life insurance companies, considering the firm-specific factors as well as microeconomic factors. And this research aims to contribute into an understanding of these determinants that affect the financial performance of these non-life insurance companies. This study will fill the gap by providing the insight on the insurance companies in the African continent. So in this slide, I'm going to be discussing the literary view, but I'm going to be giving a brief overview of the African continent insurance companies, particularly also non-life insurance companies. African insurance market is valued at 61 billion in US dollars in 2019. Despite this, the insurance companies are faced with so many challenges which make them to be difficult to adapt and also evolved toward the opportunities that keeps on rising. The insurance market remains one of the least penetrated in the global in the globe. When you're comparing it with other continents, it remains the least penetrated continent amongst all. Despite this, the non-life insurance companies plays a pivotal role in managing the company's resources, the company's assets, and still contribute to economic growth and the financial growth of any economy. Hence, this makes a insurance company to remain pivotal, to remain profitable, or to remain financial performing. A strong insurance companies will help countries to overcome their economic crisis and strengthen their economic systems. Hence, that's why we need to make sure that this financial performance, these non-life insurance companies, they are really performing, and that's why we have to look into these two components, key components that contribute to their performances. This study is housed under this particular theory, which is called a resource-based theory, this resource-based theory argues that an organization with a strategic capabilities and resources can create a competitive advantage and achieve more positive performances. Resources are utilized by the company to leverage their strength and to minimize their weaknesses and lead to companies' profitability or competitive advantage. The theory suggests that a business creates an additional value-added capacity by obtaining sustainable competition advantage. The theory explains the variation in the financial performance amongst the firm and those who effectively manage their resources and achieve their high quality product services and still have what you call sustainable economic growth. Companies that possess strategic skills and resources are more likely to generate more competitive advantage and achieve better financial performance compared to those who are lacking in such capabilities. In this particular study, we have then employed this particular empirical model data as well as a methodology. This study utilized the secondary data, which starts from 2008 to 2019. The year 2019 was chosen because that's where African insurance companies have marked was followed by the global financial crisis, which took place from 2007 to 2008. 2007-2008, the global financial crisis. The firm-specific data was obtained from various sources such as Capital IQ, Refine Inito, as well as annual reports from the perspective companies. The macroeconomic data was sourced from the World Bank database, as well as international financial statistics. The continent analysis of the annual report was significant for the data of this study. This is a regional study that covers about 48 African countries, which totals what to 120 insurers. This study has employed unbalanced panel design with an observation of 1,452 over the period of 12 years. Excuse. The panel data was justified due to its ability to account for the behavioral differences across the time as well as across sectional, and to manage homogenetical issues and allow more parameter estimation. The selection of the companies were based on the positivity sampling, considering the availability of data for the study period. The model that has been employed in the study, we've employed the static as well as dynamic panel analysis in the estimated model. The the ordinary least square, which is known as OLS method, as well as the two steps system generation method, which is of moments, which is known as GMM, was estimated technique that was being used in this particular study. And this system was deemed fit and suitable for the data set, which is larger, which is cross-sectional, and which is smaller in the time period, which is T. The choice of this estimation was also influenced by the capabilities to handle this set, to handle the set of this data with its characteristics as highlighted by this researcher. Also, the two-stage is affirmed to be optimum and more efficient. Thus, GMM was employed to estimate the coefficient and to determine determinants of the financial performance of the listed non-life insurance companies in Africa. So then we had to start by ensuring that there is two cut. We firstly create the model by ensuring that we categorize into two determinants. One, which is firm specific, and one which is macroeconomic, which have led to the model to be like that as number 2. The second one, then we started by which A was represented by which A was represented by B, and which A was represented by firm-specific factors, and then B was represented by what? By macroeconomic variables. So, and then we created and developed this model as you can see it. We then continue to actually develop and improve model according to its according to the dependent variable, which was return on asset. And return on assets has been which independent variable, which is return on asset, which this return on asset has been seen by these particular researchers to be the best variable to use in this particular study and in this nature of study. These are the variables that we have employed. One, as explained, the independent variable, which is represented by Y, which is a return on assets. We then had what you call look at return on assets, which was our X1, then X2, which is growth rate, 3, which is interest rates, X3, 4, X4, which represented exchange rates, inflation, money supply, all of those things, they fall under macroeconomic factors. Then we got claim ratios, leverage ratios, liquidity ratios, equity capital, investment capabilities, age of the company, size of the company, underwriter's risk, as well as operational efficiency. Overall, this is the model that we have developed for this study, which we said return on assets is equal to the logged return on assets plus GDP plus interest rates plus exchange rates plus inflation plus money supply plus the claims ratio plus leverage plus liquidity plus equity capital plus in investment capabilities, as well as age, size, as well as the risk, the risk underwriting, as well as operational efficiency, which are all of these variables were synced and deemed to be for this model. And then our results from the study have indicated these results are according to the correlation coefficient. Just to summarize the correlation coefficient, which is from the above table, we also understand that there is an inverse relationship between the return on assets against the size, age, underwriter's risk, operational efficiency, claims ratio, leverage, interest rates, as well as inflation rates. This inverse relationship between the companies, between the return on assets and the insurance, as well as the insurance, has been noted. The insignificant correlation between the return on assets as well as the size was also noted. A positive correlation between the return on assets as well as capital employed, as well as the equity capital, liquidity ratio, investment capacity, the GDP, the exchange rate, and the money supplies was noted. the insignificant correlation between the return on assets and exchange rates and money supply was also noted. The significant correlation between the capital employed, the equity capital, as well as the insurance age, insurance size, insurance, as well as insurance underwriters risk, leverage ratio, liquidity ratio, investment capacity, inflation and GDP, all of those were noted. Further to that, we noted a positive and a significant correlation between the equity capital as well as operational efficiency and claims ratio. The inverse and insignificant correlation with capital equity as well as exchange rates and money supplies was noted, and all of that. So we just want to quickly move to the results from the GMM, which has been indicated here. Here in the pool Likert scale, results have demonstrated that there's a significant factor of performance between capital employed, size, underwriters risk, leverage, liquidity, and investment capacities. The negative effects on financial performance was noted, which was size, underwriters risk, liquidity. The insignificant effect on the financial performance of microeconomic variables was operational efficiency as well as the claims ratio. And then the adjusted R square indicated 76%. That was selected independent variable, which explained the 76% of the dependent variable. And F statistics profitability was valued at 0.00, indicating the finest model at a 1% level of significance. And also, just to summarize the discussion based on the GMM model, we then noted that a look-at return on asset had a positive and significant effect on return on assets, confirmed by the dynamic nature of model. 2, the equity capital had an inverse and significant effect on the financial performing, suggesting that an imbalanced capital structure limits the expansion and opportunities. Operational efficiency has direct and significant effects on the financial performing, indicating that there is a sustainable and constant performance. Leverage ratio had a negative effect on the financial performance of non-life insurance companies. This signals the poor capital management, and investment capabilities had a direct and significant effect on the financial performance, indicating the maximization of investment opportunities. The GDP rate had a positive and a significant effect on the financial performance, reflecting that the economic activities had a positive impact, had an impact on the financial performance. The size had a positive but insignificant effect on the financial performance. The liquidity had a positive but insignificant effect on the financial performance. And then the interest rates as well as exchange rates, they had a positive but insignificant effect rate on the financial performance. Age had a negative and insignificant effect on the performance of the non-life insurance companies, indicating an unchanged route on inefficiencies, as well as underwriting risk had a negative and insignificant effect on the performance of non-life insurance companies, indicating an inadequate of underwriting capabilities or capacity. The claims ratio indicated a negative and insignificant effect on the financial performance of non-life insurance companies, indicating that there is a lower claims paid compared to the underwriters compared to written premiums. Inflation as well as money supply had a negative and insignificant performance against the non-life insurance companies. Then this study then from the above discussion then drew the following conclusions and then made the following recommendations. The first recommendation that was made is that insurance industry, policymakers, and government should take into consideration these significant factors in taking decision in improving their financial performance. That was number one. And second, that there should be a proper management of cash as well as capital resources, so as to benefit from the economic advantage attached. The capital structure of this insurance sector should be restructured to maintain a favorable balance of equity as well as debt of the company, and also the negative effect of the capital of the equity capital is a sign that insurance companies should intensify the adoption of departments in the source of the capital, and so that there can be expansion of the scale of operation. Also, the mechanism such as automation systems that can reduce operational cost should be adopted, such that the financial performance can be enhanced. Also, lastly, they also recommend that there should be a constant update and review of activities in the sector, as age is insignificant and negatively impacting the financial performance. This is not supposed to be as the durability of the firm should build a reputation that can easily convince policyholders to hold on several policies that will expand the operation of the insurers and improve their financial profitability. This study is limited by the inability to have a balanced panel, and also by the use of all insurance sector as some data were missing, such as for the smaller countries such as Lesotho, Swaziland, as well as other countries that where their data was not available. So also further, the research should examine the same topic using the life insurance companies, as this case will allow for a comparison finding for both life and non-life insurance companies in Africa. Thank you for the opportunity for me to present this particular work, and I hope that you have gained some insight in this particular area. Thank you so much.